One of the most common questions that I get on my channel is on the topic of whole life insurance. Now, here's the thing. If you watched any of these YouTube shorts or TikToks or any other videos, you've probably heard that whole life is this magical silver bullet of the rich that can combine both the life insurance aspect as well as this investment component of building your cash surrender value. However, it's a little bit more difficult than that. And in this video, I'm going to explain exactly how whole life insurance works, what are the benefits of it, as well as what are the potential downfalls of it. And by the end of this video, you'll know exactly who whole life insurance is right for and if that person is you. What is up, guys? For those of you new to the channel, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped thousands of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. So if that sounds interesting, I'll put a link in the description below to either check out my website or book a one-on-one meeting with myself. But without further ado, let's get right into the video. So if you notice my voice is a little bit more raspier than usual, it's because I'm just getting over a cold. So I do apologize, but let's just get into the basics of how whole life insurance works. So whole life insurance is just a type of permanent life insurance. So there's two different types here in Canada. We have whole life insurance and universal life insurance. And I've made other videos on universal life insurance. You can check them out. They're on my channel. But permanent life insurance is meant to cover you until the end. That's the main purpose of it. Whether you buy whole life or you buy universal life, the point of that type of insurance is to last until the very end. So of course, there's the question, for estate planning, what's used best? That would be permanent life insurance. But the question of this investment component, and you've probably seen these TikToks and these shorts and these other videos. And the question that I get a lot from clients is, how does it compare as an investment? Pardon me. And we're going to talk about that a little bit more in this video. Now, the other side of this is obviously term life insurance. Term life insurance is incredibly easy to understand. You can get it for a term 10, a term 20, a term 30, maybe a term to 65, or maybe a term all the way to age 100. Now, this is just meant to cover you usually for a very specific period of time. There's no cash surrender value with this type of policy. You have it for that duration. Once it's finished for that duration, you can renew it or convert it into a permanent life insurance policy with most carriers, but most oftentimes you're just going to cancel it because the original need for buying that insurance is finished now. You maybe got it because your kids are growing up, you just bought a house, you got married, you settled down, and if you're to pass away, your loved ones would of course be very financially impacted, but maybe you got a term for, let's say, 20 or 30 years. Now you're age 55 or 60, your kids are out of the house, your house is mostly paid off, you have a lot of investments, you have a lot of other things going for you. And if you were to pass away, of course, yes, there would be that emotional aspect, but they wouldn't be as financially impacted. And that's really the purpose for term life insurance. However, this video is about whole life insurance. So let's kind of talk about how it works. So with whole life insurance, we have two different components. The first component that we have is the death benefit. So this is exactly what it sounds like. If you pass away, your beneficiary gets this lump sum. The other benefit is this cash surrender value. And cash surrender value, the easiest way that I explain it to clients is it's like the equity within our home. You can kind of think about whole life insurance like a house. Just like you would be paying off a house, you can also be paying off whole life insurance. You can get different payment periods, such as a 10 pay or a 20 pay, or you could pay for the duration of your life. Exactly like paying off a house, it's like paying off a mortgage. Now, within a house, of course, you can have equity within that house, but how do you access it? You can't just go to a bank and say, okay, I want to borrow the equity I want to take the equity within my house. You have to borrow it or you have to sell your house. It's the exact same with the cash surrender value within your life insurance policy. You have this equity within your life insurance policy that you can use, and you can use it a number of different ways. If you cancel your policy, they have to pay it out to you. You can borrow against it via something known policy loan, or you can borrow against it via something known as a collateral loan. So there's different ways to access this equity within your life insurance contract. Now, one of the major benefits of having a whole life insurance contract, one of the biggest features of it is that it's a very stable and safe growth of return. And so insurance companies have been doing this for a very long time. They have a long history, a long track record of paying consistent dividends in the range of 4 to 6%. So one of the biggest benefits is that they've been doing this for a long time. This is a relatively safe and secure place to store your wealth. And one of the interesting things that you can do with whole life insurance is once you start to build some cash surrender value, you now have control over this pool of funds, which you can utilize for a number of different purposes. And where I think this really does excel is if you're doing it for some type of business or some type of investment opportunity, where you're kind of doing this double dipping thing, where you have your whole life insurance policy that's growing, you have your death benefit, and you have your cash surrender value. And as opportunities arise, maybe a condo building comes up for sale, maybe the market is really good right now, you want to get some mutual funds or some different stocks, maybe you have a business opportunity that comes up, you now have access to this capital on an ongoing basis, which you can borrow against. It still continues to grow at its stable 4 to 6% dividend return, but you can access that capital and use it in other areas. Now, I'm not going to get into the nitty-gritty of exactly all how this this work, but let's get into the benefits of whole life right now. So benefit number one, and this should be the most important thing that you think about with whole life insurance, is it's going to be lifelong coverage. This should be the initial reason that this type of product attracts you. I always say life insurance makes a terrible investment and investments make terrible life insurance. And so it's the exact same with whole life insurance. If you're looking at this as an investment, it's going to fall short of many other investments. However, if you look at it as lifelong coverage, as something that you want to utilize to pass down wealth to the next generation and possibly use during your lifetime, this is a very good benefit of whole life. The next two benefits of whole life insurance is the guaranteed and stable growth of the death benefit, as well as guaranteed and stable growth of the cash surrender value. Like I mentioned, insurance companies have been doing this for a very long time. They've had historical 4 to 6% dividend returns for the last 125 years. So this is a very safe and stable place that Canadians can store their wealth and grow it via those two different cash surrender value as well as death benefit mechanisms. The fourth major benefit of whole life insurance is there's no negative returns within your policy. And so what I mean by that? Well, with a universal life insurance policy, it works a little bit differently where you're actually just tracking the index, let's say a fund or something like that, where it has the possibility to go up, but it also, has the possibility to go down. With whole life insurance, it doesn't have that possibility. There's no negative returns within a whole life insurance contract. Once the insurance company pays you a dividend, that dividend is then locked into your contract forever. They can't take it away. There's no negative downside. You can't lose money within a whole life insurance contract. And the fifth major benefit of whole life insurance is the lending is actually quite easy compared to that of a universal life insurance contract. So like I mentioned, there's different ways that you can lend on this type of contract, policy loans and collateral loans. Now, I don't want to get too complicated. I've made other videos where I've talked about how to borrow against a life insurance contract. And if you're interested, I'll put them right there. But suffice to say, it's a lot easier to take a loan against a whole life insurance contract than it is a universal life insurance contract. However, there are some potential downsides to a whole life insurance policy, and we're going to get into it now. What are the 4 downsides of whole life insurance? Number 1, the rate of return is quite low compared to traditional investments. Like I mentioned before, life insurance makes a terrible investment and investments make terrible life insurance. If you're trying to compare this apples to apples to traditional investments, more often than not, you'll find that the rate of return is going to be quite low compared to other investments that you could get in the market. Number 2, the cost is quite high. If you compare whole life insurance to either a term life insurance policy, of course, or a universal life insurance contract, you are going to find that you're paying more for all of these guarantees that are bundled up within a whole life insurance contract. So the cost is high compared to other types of life insurance. Number 3, the commitment is quite high. And I mentioned this in a lot of my videos where I talk about if you're trying to compare it to an investment, that it makes a poor investment. And unlike a TFSA or an RSP, where you can contribute 1 year and not contribute the next year and contribute 2 years in a row and then stop for 5 years, life insurance doesn't work that way. And whole life insurance especially doesn't work that way. There are some ways that you can offset the cost of the insurance later on, but typically that's not until later years, such as year 10 and onwards. So the commitment with whole life insurance can be quite high. And if you're not prepared and committed to pay the premium for a specified amount of time, then this is probably not the best type of policy for you. And number 4, the final one, the transparency within whole life is quite low. And what I mean by that? Well, with a universal life insurance contract, you can see quite plainly that this is the cost of insurance and this is what I'm allocating towards the investment fund. And here's what it's invested in. And here's my return on these different investments. And you can see this year over year. You can get those numbers from the insurance company. With whole life insurance, it's a little bit different. It's kind of a black box of the insurance company taking in your premiums. They go out and invest it, and they're not really disclosing all that much about what the cost of insurance is and what is going in towards the investment. It's more or less wrapped up in a little bit of a black box. And at the end of the day, say, here's your returns. I hope you're happy with them. They are really good. However, we're not really going to show you how it works. And so if transparency is very important to you to see exactly where it's going, this again might not be the best option for you. So you might be saying at the end of this video, Philip, this all sounds kind of good, kind of bad. It's got stable returns. There is death benefit. There is cash surrender value. You can borrow against it. You can do all these cool things. Who is this really right for? Who should be buying this type of policy? And if you watch any TikToks or shorts or Facebook or anything like that, you'll probably think that everyone should buy this policy. And no, I do not agree with that. I also mentioned that there's many different ways that you can structure this policy depending on your goals. But what I find in this industry is the most common way of structuring this for clients isn't necessarily what's going to be in the client's best interest, but it's what's going to be in the agent's best interest. And so depending on what your goals are, you can structure this a number of different ways. However, a lot of the time, unfortunately, I do see agents structuring it in the way where they can maximize their commission, and it's not necessarily, again, what's in the best interest of the client. So at the end of the day, this is who I think whole life insurance is right for. Number one, wealthy individuals that are in a high tax rate. So again, I always talk about this in every video. Tax is the one variable that people don't consider when they start talking about this strategy. And you have such already existing, easy to understand strategies such as an RRSP or a TFSA. If you're looking for places to store your wealth, that's a great option for the majority of Canadians. However, once you start to utilize these accounts because you're a high income earner and you obviously start putting money into these accounts, you're going to start to look for additional places to store your wealth and hopefully pass it on to the next generation and utilize it during your lifetime. And if you are one of those individuals, whole life insurance could be a very good option for you. Number two, who I think this is very applicable for, is business owners. Here's the thing, and I have other videos on this. If you want to check it out, I'll hopefully put one there. If you put life insurance in a corporation as a business owner, there's so many special tax attributes that come along with it that make it way more applicable than if you had bought it personally. There's all these special little tax things that you get as a business owner when you utilize life insurance that it can be very applicable. And usually with most business owners, you also have the added benefit, of course, being a high income earner. Most business owners that are successful are high income earners here in Canada. So it's kind of a double benefit. Both are a high income earner and they're a business owner. And this could be a very good place to buy whole life insurance. And the third person who I think this is right for or could be right for is retirees. Here's the thing. Once you get to retirement and you start to actually do the financial planning to look at, okay, what do I have left over? How much am I going to spend year over year? What do I actually need? You can start to see at the end of the day, well, what don't I need? What can I pass down? What can I leave a legacy for my grandchildren, my children? Now you can start to allocate some of that capital, towards some type of policy like whole life insurance, where you can start to pass that down very tax efficiently, because not only does it grow tax deferred, but it also is paid out tax free. So this could be a very good option for those individuals. However, at the end of the day, I think the need for life insurance comes first and foremost. And for the vast majority of Canadians that are just looking to cover themselves for a specific period of time, such as you have children, you just got married, you bought a house, you started a job, you moved in, etc., etc., I think term life insurance probably is going to be the best bet for those individuals. But you can see that whole life insurance does have its place with certain people. So with all that being said, I hope that you guys enjoyed today's video. If you have any questions or comments, just drop them below. And as always, if you guys are enjoying this, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.